Hey, I'm Jusko from ProudMoney.com. Is FICO in trouble as the dominant credit score model? There is a new article from the Wall Street Journal that suggests perhaps, and we're going to talk about it. First, I'm going to ask you to please subscribe to this YouTube channel if you have not already. And if you have already, I thank you for doing so. So a new article from the Wall Street Journal that says FICO scores hold on the credit market is slipping. And you will notice they do not phrase this as a question of whether it's slipping. They phrase it as a statement that it is slipping. And I'm not quite sure what to make of it, and we'll talk about the article, but the reason I'm not quite sure what to make of it is it's commonly been held that FICO has about a 90% market share, which is sort of a near monopoly on the credit score market. So yeah, it might be slipping, but if you have a company that has such near dominance, it seems almost inevitable that it would slip at some point. So let's take a look at what the article says. And so the main gist of the article is that more and more credit card issuers are starting to use their own proprietary scores, or at least their own proprietary data, or using alternative data, or in at least one major issuer's case, switching from FICO to the rival Vantage score, which is the credit score devised by the major credit bureaus. And that issuer is Synchrony Bank, which you may know is the bank behind a lot of retail store cards. It is the bank behind PayPal's credit cards, the Verizon Visa, the Amazon store card, and a whole slew of other store cards as well. So according to the article, Synchrony thinks that the Vantage score model gives them more scores for more people. So where FICO sometimes will consider someone to be unscorable because they don't have anything on their credit report, or at least not enough on their credit report, or on their credit report long enough, the Vantage score model will often give those people a score. So there's a difference in how they do that, and obviously Synchrony Bank likes that. Now this sort of opened my eyes because I was aware that Synchrony Bank was using Vantage score to some extent, but the idea that they're using only Vantage score, not FICO at all, is new to me, and I'm still a little skeptical as to whether that's 100% true, but that is what the article says. And then the article goes on to say that Capital One does not use FICO for most consumer lending decisions, and that Chase and Bank of America have also made FICO a smaller factor when it comes to making decisions on credit. Now that last part I buy in terms of a smaller factor, because I do think that more and more the credit card companies are using FICO and then other things on top of that. And if you are someone that has had multiple credit cards, you know that some of the credit card issuers, sometimes if they have a history with you and they already know how you've done with them, well then sometimes they won't pull your credit score. Maybe they'll do a soft pull which doesn't affect your credit in order to make their lending decision. If they already know you've been paying your bills on time with them and you have some history, well then why pull your credit again when they are making a decision on a new credit card? So that part I buy, that maybe FICO is a smaller factor. I'm not quite sure how much I buy the fact that Capital One isn't using them at all and that Synchrony's not using them at all. The smaller factor makes more sense to me. Now, one of the more interesting tidbits in this article, as far as I'm concerned, was the fact that it says that FICO charges lenders 25 cents per pull, and I assume that means hard pull if they're actually making a decision on a loan or a credit card application versus the soft pull where they're sort of just looking at your background information. And the article says that this used to be in recent years 15 to 18 cents and that it's gone up to 25 cents per pull. And FICO, for their part, says that, well, it may have gone up, but it has not even gone up as fast as inflation, and so the scores are actually cheaper than they would be if you factored in the cost of inflation than they used to be in the past. Now, I don't know if that's true or not, and FICO keeps everything very close to the vest, so from a consumer perspective, you're never going to know exactly what their numbers are. Also, FICO, for their part, says that they've seen no evidence that their scores are being used less, and the article says that they have sold over 10 billion FICO scores in the last 12 months, which is fairly equal to what they have sold in the past. Now, I don't know exactly what that all means, because if they sold 10 billion and we were looking at that 25 cents per number, that would mean $2.5 billion that they made from those credit scores, and their overall revenue as a company is only about half of that. So I don't know quite what that means there. But anyway, they're basically saying we don't see any difference in what we've had in the past. We're selling just as many credit scores as we were before. And then the article also seems to take some sort of random shots at FICO, which I found interesting. One of them is a quote from Discover's CEO saying that FICO scores are good but not perfect, which isn't exactly a huge indictment. The article also talks about how Chase has its own proprietary credit scoring model that it likes better than FICO's model because of the fact that they can make changes to their internal model, obviously a lot faster than they could tweak the FICO model since it is a third-party model. And the example they use is the fact that over the last few years, a lot of people have taken out debt consolidation loans, which basically is a personal loan taken out to pay off credit card debt. And what happens when you do that is you take money that was in revolving credit debt and you put it into a personal loan, and that is installment debt. And the way both the FICO models work and the way that Chase's own model was working was that when you did that shift, your credit score would go up. Even though your debt hadn't changed, the fact that it had been shifted into an installment loan, a personal loan, made your credit score go up. Nothing else had changed. And so Chase made a little tweak to its own model, but it couldn't really do that with FICO's model. And then the article also states that FICO has been offering to give away for free its newest credit scoring models because those models are supposed to be better at getting a score for people that have thin files or don't have any credit history at all. Now, they're not completely clear in the article whether the newest credit scoring models means FICO 10 or FICO 10T, which we have talked about before on this channel, or maybe the old Ultra FICO, which was something that FICO was trying to get lenders to adopt in the past, which would include more secondary data like utilities and perhaps bank account information, that sort of thing. Supposedly the banks just said to Ultra FICO and didn't want it. So I don't know if the article is talking about FICO 10 and 10T or whether they're talking about Ultra FICO, but regardless, it sounds like the banks sort of said, nah. Now, honestly, a lot of that information I just talked about seems a little bit anecdotal, and when you are FICO and you supposedly have a market share that is around 90% of the credit score market, well, then it seems inevitable that some competitors are going to start eating away at that market share. But there is one place where I can see that FICO could very much be in danger, and that is the mortgage market. So in the mortgage market, FICO has almost a legal monopoly, almost a government-sanctioned monopoly, which is not easy to explain in few words. But essentially, a lot of lenders are almost forced to use FICO scores in making their mortgage decisions. And because of that, a lot of lenders, and this makes perfect sense, just decide to use FICO across the board. So if we have to use it in the mortgage market, we'll use it for credit cards, we will use it for auto loans, etc., etc. And so that means any competitors would have a tough time making inroads in if FICO is already being used and if, the lenders are happy enough with it. However, there has been a movement by VantageScore in particular to say, hey, why does FICO have a monopoly here? Why are you only using their scores? We have scores that are good too, and we can score more people than FICO can, and maybe that means that you could even have lenders giving out more mortgages, especially to people that are, first-time home buyers or maybe lower credit scores, don't have much of a credit history, all of that good stuff. So maybe we would do a better job, and the government to some extent also is looking at that and saying, well, maybe that's true. Maybe VantageScore should have the ability to have their mortgage scores being used by lenders as well. And so if VantageScore can get a foothold in the mortgage market, well, then all of these lenders that are just using FICO across the board might over time have less of a reason to say, well, we're just going to use FICO everywhere, because once they start using VantageScore in some of their mortgage scores, well, then maybe they'll say, we'll use VantageScore everywhere. And that's where FICO could really see some trouble. All right, so FICO really is slipping as the dominant credit scoring model. What does that mean for you as the consumer? Well, it could mean good things, especially if you are someone newer to credit and FICO was not showing a credit score for you at all, or you didn't feel like they were giving you enough credit for the things that you had done in the past, and maybe the VantageScore model was scoring you higher. Maybe you would be happy to see VantageScore gaining more market share. But there also could be confusion in the market, because I think up until now, and I include myself in this in terms of my own thinking, I have always thought of the FICO score as sort of your real credit score, because that is the score that most lenders have used traditionally. If VantageScore comes in, that means not only you're going to have the FICO score, but you're also going to have the VantageScore as a real credible player in the market, which means you're going to have all the multiple FICO scores that are out there, as I've talked about in other videos, with multiple credit reporting agencies, all that kind of stuff. You have a zillion FICO scores out there. Then you could have a lot of Vantage scores out there that are different between different credit reporting agencies. And then you would ask yourself, well, what's my real FICO score? And you could use any of them as sort of benchmark to see how you're doing over time. But if you're someone that has ever looked at both your FICO score and your Vantage score, especially if you are newer to credit, it is amazing sometimes how your score can be 50 points different or more depending on what you are looking at. So it definitely could create more confusion out there for people when they don't know what their real credit score is. Now, it doesn't necessarily make a difference over time which credit score is used, because the credit scoring models are still mostly going to reward and punish the same things. You make your payments on time, good. You don't make them on time, bad. If you carry too much debt in relation to your available credit, bad. So it's sort of the same stuff in both of them. But for example, if the Vantage score does give scores to people that have thinner credit files, well, then maybe you would rather that be used and maybe that wouldn't be used, or vice versa. So there is going to be some confusion if it changes. That doesn't mean it shouldn't change. Competition is generally a good thing, but it could create more confusion, much in the same way that I don't know who to use for my electric company anymore, where there used to just be a monopoly and I just had to pay whoever my electric company was. So once competition comes into a space where we as consumers, we're not used to it, well then we don't necessarily know what to do with the information that we get. So it's definitely something to watch. I actually checked FICO's stock price today as this Wall Street Journal article was coming out, and I see that it's about minus 2% or more, while the rest of the stock market is flat. And I'm sure it has to do with that article coming out, basically saying that their business is slipping. So that's certainly nothing that they want to be hearing. So you can imagine that FICO is going to be doing whatever they can in terms of damage control, and then also just whatever they can to make lenders happier with them. So it will be interesting to see what happens here in the near future. I'd love to hear your thoughts in that comment section below. Otherwise, I thank you for watching. And as always, please go to proudmoney.com, where we do credit card reviews and we talk personal finance and we talk deals, all sorts of other fun stuff too. Thanks for watching. Bye.